So let's begin with the discussion. Today we are going to be starting with the revision of portfolio management. Now, portfolio management is one of the easier topic because it has a lot of references to the rest of your syllabus. I would recommend that when you are revising portfolio management, this should be one of the last topics that you cover up, because when you read through the books or you read through the notes, you will find a lot of references to material we have already covered in equity, in fixed income, and derivatives. So this topic, if you treat it as a standalone discussion or you cover it first before all the other topics, then it will be a lengthy topic to understand. But when you approach it as the final topic of your entire CFA preparation, then portfolio management becomes an easy topic. It does have sizable weightage compared to other smaller topics. It's about 8% plus for portfolio management. But overall syllabus, the more you link it with other topics, the easier it gets. So we split the syllabus into two parts. One is portfolio risk and return. And then we have all the other topics. In this others discussion, we have portfolio management overview. We have portfolio planning and construction. Then we have behavioral biases. And lastly, risk management. So 6 topics in total, covering the entire discussion of portfolio management for CFA Level 1. So portfolio management, we'll start first with our discussion of risk and return, and then we'll move over to all of these theory topics. For these theory topics, we mainly convert our discussion into a mind map. So for these two topics, portfolio management overview, planning and construction, we have a combined mind map because it's a discussion that flows from one topic to another. We'll have a mind map for behavioral biases and one for risk management. Write the first heading, portfolio risk and return. Now, in your books, they have given the discussion of risk and return in 2 chapters, reading 1 and 2. We will combine both the discussions into a single section. The entire discussion of risk and return can be split into 3 parts. First is calculation of portfolio return, which is a simple weighted average. Weighted average of return of all the constituents of my portfolio. So all the securities that make up the portfolio, all of their returns weighted average becomes my return of portfolio. Risk of portfolio is weight of A square, risk of A square, weight of B square, risk of B square, and twice weight A, weight B, risk of A, risk of B, and this last symbol, this is correlation of AB. Now, this entire section is same as quants. In fact, in the topic of quants, you will find more practice for these particular calculations, because individually calculating return, risk, correlation, sometimes even covariance matrix, all of that is part of your quant syllabus. So a better practice for this particular section of the chapter will be done when you revise the quants chapter. Quants has a full chapter for portfolio mathematics that covers this entire concept. So in portfolio management, this just is a couple of equations which are given to you as a recap. The actual true discussion for us, one is theories of optimal portfolio. Then we have final discussion of portfolio performance evaluation. Portfolio performance evaluation are just a few basic ratios comparing the risk and return of portfolio or comparing the returns actual versus what we were expecting. So we have Sharpe ratio, Trainer ratio, we have Jensen's alpha, and we have M squared. So all of these techniques of evaluating the portfolio performance, you should be comfortable with all of them. For us, with the objective of revision, the primary topic that we need to focus on is the theories of optimal portfolio. Essentially, if we revise this properly, a lot of theory questions that can be asked from the chapter, they get sorted out, because calculations, they link with quants. These are just basic ratios. So long as you remember the formula, you'll be able to answer them correctly. But the one part where you will have to apply your mind to answer the questions is the theories of optimal portfolio. So here we have three theories: capital allocation line, capital market line, and security market line. So let's approach them one by one. Starting first.
Sir, I have one question related to
Yes, go on.
this. So the
Go on.
coefficient of correlation which we are talking about. So when we
Yes.
input the data of portfolio of A and B and we get average return when 5 years is given. So
Correct.
when the sigma which comes as a R or that goes into that place, right? In the correlation coefficient.
Yes, R is what you get in the calculator.
And that will be used for calculating the risk.
Correct.
Okay.
All right. Capital allocation line. This is the concept of an optimal portfolio from an investor's perspective. From an investor's point of view, if I have returns and I have risk. Now, here we can also write simply weightage of risky securities, because in this entire theory, we believe that every portfolio that an individual can construct is a combination of risk-free securities and risky securities. So if I classify all the risky securities as a risky portfolio by itself, essentially the risk of portfolio will come primarily from how much money I am investing in the risky securities, because these securities have zero risk. So in your books, you will find graphs with both labeling. One says risk of portfolio, the other simply labels it as weightage of risky securities. CAL is a straight line sloping upwards. Starts from the risk-free rate. And the idea is, as I start investing more and more of my money in risky securities, because when will I be earning risk-free rate? When 100% of my portfolio is invested in risk-free securities. So slowly, as I start changing weightages, slowly as I start taking more and more risk with my portfolio, as the risk goes up, my expectation of return also goes up. Now, CAL is nothing but all the different portfolios that an investor can invest his money in. So if I have certain amount of capital, I can invest it in all of these combinations. Every single point on the CAL represents a possible way in which I, as an investor, can invest my money. But the question is, out of all of these possibilities, which one is ideal? For that, we introduce the concept of indifference curves.
You
Indifference.
can't see the lines. You have taken the highest line.
All right, wait. So if CAL is a combination of all the different portfolios that we can use, then from this, we will pass a bunch of different indifference curves. The logic of indifference curves is that they represent all the portfolios towards which an investor is indifferent. So if I were to have portfolio 1 and let's say portfolio 2, 1 is giving low risk and low return. 2 is much more risky, but for that extra risk, it is also providing the investor with more returns. So what we say in case of indifference curve is that all points on single curve are equal for investor. So for an investor, and generally when we say investor, what type of investor we are talking about? We are talking about a risk averse investor. Someone who is only willing to take risk if the same is being adequately compensated by appropriate returns. So three types of investors we can have: risk seeking, the ones who are actively looking for risky investments. Then we have risk neutral, for whom risk is not a big factor in decision making. And then our default investor, a rational investor, is a risk averse investor. He is willing to take risk provided the returns are adequate. So when we say point 1, point 2, these are two portfolios on the same curve. We are saying for a given investor, both of these are equal because as per this investor, whatever extra risk he is exposed to, he is getting adequately compensated by that extra returns. So risk averse doesn't mean avoiding risk. It simply means I am willing to take risk if the compensation is adequate enough. So with this logic, we conclude that indifference curve, all the points on a single curve are equal. But if I have to compare different curves, higher is always better. So the point where the highest indifference curve intercepts the capital allocation line, that is called the optimal portfolio. So the point where highest indifference curve, so out of all the curves, highest will be decided by the ones which are at least intersecting with CL. Because if this is my total capital as an investor, I can't invest more than the resources I have. So any indifference curve which is entirely beyond CEL, irrelevant for us. Now the ones which are at least intersecting with CEL somewhere, out of all those curves, wherever the highest is intersecting the capital allocation line, that is referred to as my optimal risky portfolio. And why is this important? Because this gives us an indication of how much weightage of risky securities should an investor go for when he is constructing a portfolio. So when we want to make a portfolio, this as a theoretical idea gives us a clarity as to how we will figure out what amount of risk may be suitable for an investor, how much money we should be investing in the risky securities. So this is the idea of capital allocation line from the perspective of an investor. Any doubts or queries you guys have, let me know. All right. So this is the first theory which tackles the entire problem from an investor's point of view. Now let's look at the second theory, which focuses on the market as a whole. So this is capital market line. Capital market line is the theory of optimal portfolio or optimal risk from the perspective of market. So you may have often heard that market is too risky at the moment, or the market is very overvalued. We need some correction in the market. All of that is a reference to the idea proposed by this theory. So here we have returns of portfolio and we have risk of portfolio. And in terms of graph, CML looks exactly same as capital allocation line, starts from risk-free rate, goes upwards. But what this represents are different market portfolios that an investor has access to. So if I want to invest in market, I can go for some ETFs, I can go for some mutual funds, I can go for some index tracking funds. I can also create my own portfolio to replicate the performance of index. All of these different alternatives will expose me to different levels of risk, and I will earn different levels of returns. So CML is just all the different investments I can make in the market. Now here also, we have a concept which we use. The concept is called efficient frontier. What is efficient frontier? Basically, if I create a collection of all the different portfolios which are available in the market, right? Each dot here representing a possible portfolio in the market containing only risky securities. So these are all the risky securities in which an investor could have invested in the market. The most rewarding out of all of these options make up the efficient frontier. So essentially, for any given level of risk, the most rewarding portfolio, the ones which are giving you maximum return in the market, combination of all of those best portfolios, that is referred to as efficient frontier. We believe that in the market, if we have rational investors will focus on investing only on the portfolios which align at the efficient frontier. Does the actual market have only informed investors? No. So this theory is just giving us an idealistic version of what is the ideal level at which market should operate. Whether market will actually operate at that, it depends on the demand and supply. It depends on the market sentiment. So we are not saying this is how the actual market will work, but this is how we figure out whether actual market is overvalued or under. So logic is that if all informed investors are operating at this efficient frontier, wherever this intersects with the market, this represents optimal market portfolio. This is the ideal level of risk that should exist in the market. Sometimes the risk may be too high. This is an overbought market where people are very optimistic. And as a result, we are operating in a market where the risk is very high compared to what it should be. And on the other hand, we have oversold market where investors are very pessimistic. They are not very positive. They have very negative sentiment. They are very afraid of the market or the investments. In this case, the market will operate at very low risk and very low returns. But the problem is market is capable of providing more returns if the investors are willing to take a little bit more risk. So this is a problem where investors are not taking enough risk. And this is a problem where investors are being too risky, too optimistic with their investments. So for the market also, we have an ideal level of risk. The point where this optimal portfolio intersects, this gives us the optimal risk which should exist in the market at any given moment of time. Any doubts or queries with capital market line?
So can you explain once again the efficient frontier?
So efficient frontier is a combination of all risky portfolios available in the market, but the ones which are most rewarding. So if let's say at this particular level of risk, you have portfolio one, you have some portfolio two, three, and four. As an investor, which one would you choose out of one, two, three, four?
Or
Four, because it is giving you maximum return for the same level of risk. So if I were to do this for every single risk, for every level of risk, the best portfolio that I have, combination of all of those is what creates efficient frontier.
okay, sir. Thank you.
The last theory that we have here is security market line. This is graphical representation of capital asset pricing model. Graph will look pretty much the same, except we now have return mostly of equity. And on the x-axis, we have beta. Beta is a measure of systematic risk. So total risk that an security is exposed to can be split into systematic, which is system-wide risk. Basically, every security in the market will be exposed to this. And then we have unsystematic risk, which is specific to a company or an industry. Unsystematic risk can be diversified, which means as an investor, if you focus on diversification of your portfolio, you can manage this particular source of risk. Systematic is undiversifiable, meaning you cannot get away from this risk. This will be there if you are investing in the market. Now, why is this important? The security market line or capital asset pricing model, it says that investor should expect compensation only for systematic risk. So as an investor, when you enter the market, CAPM says that unsystematic risk, you could have diversified if you chose to make your portfolio or build your portfolio in a very intellectual or a rational manner. So if you were to arrive at all your investment decisions using logical thinking as an informed investor, this is a risk that you should have been able to manage. So if this is something that you're exposed to, CAPM says you chose this exposure. If your portfolio has unsystematic risk, it is because you chose not to diversify it. At that point, if you are consciously deciding not to diversify your portfolio, you should not be expecting the market or the security to compensate you for that. So this approach says that when you make investment, one type of risk you can manage, so this is your responsibility. The risk which you cannot manage, only that should be the risk for which you should expect compensation in the market. So that is the idea of security market line. So we start from risk-free rate, it goes upwards. And for this, we have the equation risk-free rate plus beta, market return minus risk-free rate. Now, on the same lines, the previous model, CML, this also has an equation. This is risk-free rate plus risk of portfolio upon risk of market. So same equation as SML, you just replace beta with total risk. Now, this line represents the ideal return. So this entire line, SML, this represents the ideal returns a security should be generating. If actual returns are high, it must be that the security was undervalued when you actually bought it. So When the actual returns are above the SML, it represents undervalued securities. And when the actual returns are below SML, it represents the securities are overvalued. Overvalued security is already very expensive. It will not generate as much returns. And undervalued are available at low prices. They will create more returns for the investor. So if SML is the ideal returns, if I want to earn more than that, then I will have to pick out securities which are undervalued. And if I want to, not want to, but if I'm earning less returns than what is implied by CAPM model, then I must have invested in some overvalued securities. So this is very likely to be tested in the exam in form of theoretical questions, because on the graph, it seems counterintuitive that we are going up in the graph and we are labeling it as undervalued security. Any doubts or queries anyone has with the entire discussion of portfolio risk and return?
Sir, can you go to the back slide for just 1 minute?
You'll have PDFs for all these notes. No need to take notes at the moment.
Sir?
Yes.
So basically, the CML dictates the ideal return, giving the whole total risk, and SML considers only beta, right?
Yes. SML is also for a specific security, while CML is for the entire market. So that is also another layer.
Okay.
Let's continue onwards to the theory topics now. We have portfolio management overview. And planning and construction. We take up a combined discussion because almost 80% of our discussion across the two topics, it can be summarized together. We can combine a lot of discussion from first chapter with second chapter by taking some references. So let's start with the first basic part, which is the portfolio management process. Portfolio is a collection of all assets and liabilities, not just the ones you buy for investment, but all assets and liabilities. Because even if you have some assets which you didn't buy for investment, simply existence of assets has the ability to change your risk appetite. So we consider portfolio to be a combination of all of your assets and liabilities, and managing them is what we are referring to as portfolio management. So this process is a three-step process. First is a planning stage. Planning stage is where you collect the information from the client about their financial background, their investment history, their income sources, family members, how many are dependent, how many are independent, all sorts of details which will help you create a good portfolio for a client. All that information is generally collected in the first step. This step can be explained simply with a term IPS, investment policy statement. And this is essentially a summary or a formalized version of all the information we collect from the client. Now, here, not only do we collect the information from client, but generally this is a stage where we also start figuring out what sort of investment would actually make sense for the client. So in the IPS, we have two sections. One is objectives, which is just risk and return. How much risk should the client take and how much return will be suitable for the client? Risk also depends on two things. One is willingness, which is completely psychological. It depends on the psychological construct of the investor, whether they are willing to take risk or not. And then second is ability. This depends on the financial background of the investor. It is possible someone has a lot of resources, so they have financial ability to take risk, but psychologically they are not very interested in taking risk. So generally, what we classify as risk is a combination of the willingness as well as ability. Generally, out of these two, whichever is lower, that becomes our risk tolerance. But the idea is over time, whatever gap is there between willingness and ability. In ethics, you study this, that we have to constantly communicate and try to make the client more informed so that we can bridge this gap between the willingness to take risk and the ability to take risk. The second section of IPS is the constraints. Constraints are basically everything that will limit my ability to create the most optimal portfolio. So what we covered in the theories, this is theoretical version of what is the best portfolio I can create for my client. But in real world, there will be a lot of issues which limit my ability to actually reach that optimal level. All of those are referred to as constraints. So this will include taxation, time horizon, liquidity. Liquidity would mean that the investor may, from time to time, need some funds. He may want to withdraw funds for some purchase or for some expenditure that we have planned. Then there could be some legal constraints and any other unique restrictions that the client may impose. So all of these factors limit my ability to actually reach the optimal portfolio. So what we have just defined as optimal in previous few slides, all of that is dependent on the real world market conditions. So if the market conditions are not quite aligning, or maybe the client is not quite matching in terms of ability and willingness, so all of these factors will limit my ability to get close to the optimal version of portfolio. So constraints are everything that limits my ability to reach closer to optimal portfolio. In simple words, if there were no constraints, then every financial analyst will prefer to create an optimal version of portfolio. But we can't in real world because there are constraints. Then, second step that we get to is the execution step. This is where we finally create an investment strategy and we start making investments according to that strategy. Generally, whatever strategy we create here is also specified in the IPS for future references. So there are three major execution approaches. One is called strategic asset allocation. Strategic asset allocation is more long-term plan as per IPS. So as per whatever information you have in IPS, we will construct a long-term plan of investment. Here, we will generally specify the sectors or the asset classes in which I will invest the money and how much money I will be investing in each of those respective assets. So all of those details will be classified here. So let's say I have a client who wants an equity-only portfolio. So based on the market conditions, based on client's financial background, I decide that we'll invest in 5 different sectors. Let's say aviation, banking, pharma, infra, and IT. So for each of them, I will decide how much of my portfolio do I want to invest? How much money do I invest? Now, all of those weightages are generally given in range, because if I say I will invest 20% of my money in IT, the next day IT stocks may go up or down and that weightage may change. So I don't specify the weightage as a single number. I specify it as a weightage so that it leaves room for fluctuations to happen over time. Now, this is long-term plan, but over short periods of time, market can create opportunities which can be exploited, which can be taken advantage of. Whenever such opportunities arise, that is tactical asset allocation. So this is deviation from strategic asset allocation. So whenever there are some short-term opportunities which arise in the market, I will see whether those opportunities can be exploited while staying within the limits of IPS. Just because an opportunity is there doesn't mean as an analyst, I always have to exploit it. I will still check whether this opportunity is suitable for my client or not. So if it is suitable, then the objective is that we will see if we can deviate a bit from our long-term allocations for a small period of time, maybe 2 months, 3 months. So if I have 5 sectors in my portfolio, all of a sudden automobile is creating a good opportunity for, let's say, next 3-4 months. So for this short period of time, I decided to sell some of my other investments, move money to automobile. After the opportunity is exploited, I will come back to my strategic asset allocation. So this is not a long-term deviation. This is just a short-term deviation with a plan to come back. And then third approach we generally use is a sector rotation strategy. Sector rotation focuses on few best performing sectors. And the idea is my portfolio will just comprise of these sectors. As some of these sectors reach their saturation point as they are getting to a point where they are no longer the best performers, I will start moving my money away from them and start looking at newer sectors which emerge to be good investment opportunities. So that is the objective of sector rotation. And the last step that we have in this entire process is feedback step. Feedback or follow-up, it simply says that this is not a one and done process. This is something you will keep revising as new information emerges, either from the side of client or from the market perspective. So based on whatever is happening in the world, either on the client end or the market end, as new information emerges, we will keep taking that into account and start considering whether it is something that warrants a change in the portfolio or not. This is basically where all the portfolio actions related to rebalancing or reconstitution, they will take place in the feedback step. Because once I construct the portfolio, I will then make some changes over time as per the market conditions. So rebalancing, reconstitution, all of them are part of feedback stage. So this process is mentioned in the overview topic, but the details that we have covered with the process, they are covered in planning and construction. So for this purpose, I always advise that students should study both of these chapters back to back. Don't give any break in between. Don't treat them as two different chapters. Treat them as one common topic flowing from one reading to another. Any doubts till this stage? Now, apart from this, there is a small section talking about different types of investors that we can have: individuals, insurance companies, banks, pension, and so on. For that, I would request all the students to refer the table that we had taken in the main class, because that table essentially works very well. So depending upon the type of client, we have individuals, we can have mutual funds, or you can even write the word pooled funds here. Then we can have pension funds. We can have banks. We can have endowment and foundations. Endowment and foundation are from universities. One is for regular ongoing support like scholarships, and the other is money that the universities receive for specific research purposes. So across all of these and other clients also, what we notice is that based on time horizon, for insurance, we generally can create two different conclusions based on whether it's a life insurance or is it property and casualty insurance. Life and health is one category and property and casualty is the second category. So we can derive their risk appetite or risk tolerances based on two factors. One is the time for which they are going to be investing. Because any investor who can stay in the market for long periods of time, they generally don't have to worry too much about the cyclical effects. So long-term time horizon generally increases the ability to take risk because you limit your exposure to economic cycles. So now you have more exposure freed up to take risk in other sides. Then we have liquidity. Any investor who may need cash urgently will not be able to invest in risky securities which may be of illiquid nature. So this also becomes one of those factors that affects my risk tolerance. And both of these will give me an idea about the risk tolerance that all of these investors tend to have. Now, for individuals and mutual funds, there is no definitive answer because it will differ from person to person. It will differ from fund to fund. There are some funds who will have more liquidity requirements. There are some funds who will be investing long term, some investing short term. So in these two categories, there is no definitive answer we can give unless we have details of individuals and details of mutual fund. Pension has very long term time horizon. Pension is not short term. And because it is long term, they also don't need to have a lot of cash with them at all times. Because if I'm planning to give pension payments to employees when they retire, and I have an average age of all the employees who are working in my organization, then I can sort of make a prediction as to when I will start making those payments. So I don't need a lot of cash with me. As a result, they have high risk tolerance. Same logic would apply for insurance companies also, life and health. This is long term, requiring low liquidity. So they have high risk tolerance. Whether this high risk tolerance would actually be exploited by these parties or not, that is completely different matter. Because insurance companies may have the ability to take risks, but the problem is insurance regulators may restrict where they can actually invest their money. Same thing happens with regulators governing pension funds. So we are simply talking about, as an investor, how much risk tolerance they have. Whether they will take that much risk in the market or not, that's a separate matter. Then banks have very short-term horizon because people who deposit money in banks, they can withdraw the money whenever they need it. So as a result, they need a lot of cash available at all times. And because of this, they don't have the ability to take a lot of risk. And same is observed in property and casualty insurance because these are short-term insurance policies, 1 year policies to be renewed with new premiums. Somewhere in between sits endowment and foundation. So we will write it as medium only because it will give you a little bit of a helping hand in the exam. Because if you get options asking you which of these has longest time horizon and they give you, let's say, bank, property and casualty, and endowment, then you know that endowment has much more long-term time horizon than the bank and property casualty insurance. So writing medium is so that you have exact context whether this is on the higher side or lower side. If I were comparing endowment and foundation with pension funds or life and health insurance, then it is not as long term. So in your books, they have written it as long term, but for clarity and for a little bit more help in the actual questions, make sure you write it as medium so that you have clarity. It is not as long term as pension funds, but it is longer term than the banks. Kumar, that will depend on the market conditions. Any doubts or queries till this stage? Krish is asking, endowment or foundations, will they be perpetual? It depends. Like if it's a fund where constantly we are receiving new donations or new contributions from members, then we can keep running the same fund for a long period of time. So it is possible we manage it endlessly. But mostly if, let's say, some money is received for a specific purpose or specific research, then generally I can only use it for a certain period of time and then I have to exhaust the fund. So it will depend. It differs from case by case basis. There's no like one right answer there. It will depend on the situation. Last bit of discussion that we have in this combined sort of chapters is pooled funds. This chapter is where you have a slightly more detailed discussion about mutual fund structure. Mutual fund is a lot of investors, smaller investors pooling their money together, and then the fund manager will decide where to invest that money. But apart from mutual fund, we have also covered private equity fund. We have covered hedge fund. We have REITs, real estate investment trust. We also have ETFs, exchange traded funds. So there are a lot of other types. ETFs you study in detail in level 2. There is just a small difference you need to know for level 1. We'll cover it. All the others, these three, you study in alternative investments. So what discussion do we have for mutual fund in this chapter? Mutual fund can be of two types: open-ended or closed-ended. Open-ended mutual fund means that over here, whenever an investor wants to invest in mutual fund, they will directly deal with the mutual fund. So let's say I want to invest, I will give my money to the fund. They will issue new units. Units or shares, both words can be used for mutual fund. So they will issue new units in my name. And when I want to sell, at that point also, I will go to the mutual fund, give them the units back and ask for my money in return. So this is essentially a fund which will operate always in primary market. Whenever you want to buy or sell, you will deal directly with the fund. They will create new units and they will redeem existing units throughout their lifetime. Closed-ended funds generally do not have this. Closed-ended funds work very similar to how the IPO works, that one time they will issue their units to the public, but from that point onwards, if any member of the public wants to sell their investments, they can do it in secondary market. So if the fund has a lifetime of, let's say, 10 years, they will issue the units at time zero. After that, as an investor, if I want to exit in 2 years, I will have to sell it to some other investor in the market. The fund will only return the money at its closure. Now, open-ended tends to have one problem because we are allowing creation or redemption of shares or units whenever the investor wants. It is likely that when the market is down, a lot of investors will panic and they will ask for their money back. So it will force the mutual fund to sell a lot of their investments when the prices are low. So to fix that, sometimes they put up a redemption fees. So funds that have fees on redemption are called load funds. And the ones which have no such concept of redemption fees or redemption charges, they are referred to as no load funds. Now, for your syllabus, ETFs, you only need to know what is the difference in ETF and closed-ended mutual fund, because this is also trading in secondary market. This is also in secondary market. So ETF is on exchange. Closed-ended mutual fund may or may not be on exchange, but that's not the separating point. What separates closed-ended mutual fund from ETF is ETFs are mostly passive index tracking funds, which means they are not designed or operated to outperform the market, to out-earn the market. They are designed primarily to replicate the performance of market. So if Nifty is the index that I'm tracking, if Nifty is generating 12% return, an ETF will also try to match that. But a closed-ended mutual fund is active investment fund. Active investment means they are primarily trying to outperform the market, generate more returns than what are available in the market. So this is one key thing that segregates closed-ended funds with ETFs. There is a very big difference in terms of the legal structure, how they are created. That is what you study at level 2. So we can't get into that discussion at the moment. So for your level 1 syllabus, ETFs and closed-ended mutual funds, the difference you have to remember is that closed-ended mutual funds are mostly active, while ETFs are passive index tracking funds. Any doubts or queries you guys have in both of these chapters, portfolio management overview and portfolio planning and construction? This leaves us with two small topics, risk management and behavioral biases. Samarth, open-ended means that for every investor, they will create new shares, new units. So if I want to buy mutual fund, I will buy it directly from the fund, not in secondary market. And when I want to sell it, I will sell it directly to the fund. Again, not to another investor in the secondary market. So open-ended funds can be thought of as funds which will operate always in primary market. So next up, we have behavioral biases. Behavioral biases is a chapter designed primarily to introduce you to what we consider as market sentiment. It is not designed for you to become some sort of AI or robot completely devoid of these psychological issues, but rather for you to understand that the rest of the market, all the individuals in the market, they are going to exhibit these biases. So you eliminating them doesn't create any benefit for you. Rather, you understanding how everyone else reacts in the market based on these biases, that is a bigger takeaway from this chapter. So when we talk about behavioral biases, there are two types of biases: cognitive and emotional. And within cognitive, we have further two categories. One is belief perseverance, and the other is information processing errors. Belief perseverance means that once you form a belief, generally you're not willing to change it too much. So let's start with each category one by one. The first belief perseverance bias is conservatism. Conservatism means forming an opinion and then completely avoiding any change in that opinion. So let's say with proper analysis, you arrive at a conclusion that, okay, one company is good, I should invest in it. But from the point where you made the investment, you decided to completely ignore any information. You create an opinion and then you stick with that opinion, not changing it, no matter how the information is emerging in the market, how the market conditions are evolving. So forming an opinion and not changing it, that is called conservatism. Then we have confirmation bias. This is forming an opinion, but you accept new information which further validates your previous opinion. So in conservatism, you form an opinion and then you pretty much ignore all other information. You have an opinion, so you're sticking with that. So you completely ignore any new information which is emerging. But in confirmation, you form an opinion, you are selectively highlighting the information which validates your previous opinion. So basically, you are only ignoring contradictory information. Then we have representativeness bias. This is our tendency to apply some characteristics to securities because we believe they are part of some group or some other basket of securities. For example, any company of Reliance Group or Tata Group will generally be considered much more safer than any of the new age startups because they are part of a larger conglomerate. So that is referred to as representativeness bias. Now, this representativeness can be because I am looking at very limited data. So sometimes when we look at some industries which only have 2 or 3 companies, it is possible that we are arriving at conclusions because those few companies are performing good. My sample is not large enough. And sometimes I completely ignore the probability that whether all the features of Tata Group company will apply to every company or not. So all of those are issues of probability. So both problems can exist here. Then we have illusion of control. This is where investor is having the illusion that they are somehow in control of all the returns and all the benefits which are being generated in the market. This thing in emotional side is called overconfidence bias. So what we call overconfidence from an emotional perspective, the same thing is called illusion of control from a cognitive point of view. And then we have hindsight. Hindsight is the habit of analyzing past based on new information. Logically, if there is some investment decision you could have taken 2 years ago, the only thing you should use to review that decision is the information you had access to 2 years ago. If you're using current information to judge whether 2 years ago your decision was correct or not, then that is a hindsight bias because you are using information which did not exist at the time of making decision to decide whether decision was right or not. When I have to make a decision, I can only look at information at that point of time. If I knew what would happen in the future, then maybe my decision would have been different. So we have a habit that we study our past using information which exists today, but it did not exist when I had to make the decision. So that is hindsight bias. And this emotionally creates regret aversion, that we often take decisions because we suffered regret with some past investment decisions. We don't want to suffer that regret again. So sometimes our investment decisions are not driven by logic or by analysis. They are driven by our need to avoid repeating some regretful action. These are all the belief perseverance biases. Then we move to information processing biases, where first is anchoring and adjustment. Anchoring and adjustment, as the name suggests, you create some sort of an anchor point. So you form an opinion. Now you are willing to change that opinion, but only by a small amount. So now compare these three. Conservatism, you form an opinion, completely ignore all the new information. Confirmation, form an opinion, only accept new information which validates your opinion. Anchoring and adjustment, you form an opinion, you're willing to change it, but not change it enough. So this is very common in case of credit rating or stock recommendations, that if a company has given rating to a particular security, AAA, even if some bad news comes out, they will not degrade it directly to C. They will degrade it maybe from AAA to AA plus or AA, maybe 1 or 2 ratings. So when ratings have to change, you are influenced by your previous rating. That is referred to as anchoring and adjustment. You're not able to make a sizable adjustment because you are stuck at your anchor point. Very important that you have clarity on the difference of the three. Then we have mental accounting bias. This is our tendency to view income differently based on the source of earning. So if you are earning salary, you will take less risk from it. But if you win a lottery, you will be willing to take more risk with that money. That is a bias because ideally all the money is yours. So you should be taking informed decision on all of the funds that you have available. But as humans, we have tendency to view money differently based on the source of its earning. So that is mental accounting bias. Then we have framing bias. Framing bias is being influenced by how the information is presented to me. So if I say inflation is 8%, it seems very high. But if I say inflation is just 1% over the target, then 8% may not seem fine. If a country has 7% inflation target and they say inflation is just 1% above target, it doesn't look as bad. So we as humans are influenced by how information is presented to us. So that is called framing bias. If we want an unbiased approach, then we should be focusing on information, not how it is presented. But the fact that humans are influenced by how the information is presented, that is referred to as framing bias. And then lastly, we have availability bias. Availability bias means it's a habit of humans to put more importance to the information which is more easily available. We prefer not to do too much analysis. We prefer to look at the information which I have access to easily and use that as the information from which I will form my opinion. So if you all had to make investments, chances are most of the people are not doing any assessment themselves. They are simply looking at some assessment done by another analyst and simply copying it. Why? Because someone else's work is more easily available than doing the work yourself. So that is availability bias. And lastly, we move to the emotional biases. 2 of them we've already written. The third that we have is loss aversion bias. So generally, we believe that investors are risk averse, but actually investors are not risk averse, they are loss averse. They are going to feel much bad if they have a loss of certain amount as compared to the happiness they will feel in case they have profits of the same. Then we have status quo bias. Status quo is simply reluctance to change. This is different from conservatism because here you are not reluctant to change. You are just too rigid in your opinion. Here we are saying you invest money and now you are not interested in revising your investment policy at all. So it's not a rigidity of opinion. That is a rigidity of action. So this is you being rigid with your opinion. This is you being rigid with your actions. Status quo means I take some action and now I don't want to do any further action. Essentially being lazy. That is what status quo means. Status quo simply means happy with the existing situation. Then we have self-control bias. Self-control is basically lack of self-discipline. A lot of investors, they don't have the self-discipline to stick with a well-devised strategy. Let's say you make a strategy to invest for 10 years. After 1 month, you check your demat account and a lot of the investments are in red. You are suffering losses. Chances are a lot of investors will panic and they will simply exit. A 10-year strategy is being judged and being removed based on 1 month of performance. So investments require some self-discipline to stick with a well-devised investment plan. So when investors have a lack of self-discipline, that is what we refer to as self-control bias. And then lastly, we have endowment bias, which is the habit of investors to be more attached to some assets which have some emotional value to them. So maybe some family house or some family heirloom. These will generally create decision making, which will not be driven by investment logic, but rather these decisions will be driven by emotional aspects, by psychology of the investor. So there are some investments or some assets towards which we will have more emotional attachment. So we will not be taking completely investment or logical decisions there. Some of our decisions will be influenced emotionally. That is referred to as endowment bias. So that covers up our entire discussion for behavioral biases. Any doubts or queries you guys have, let me know.
Sir, how insights and risk regret aversion is comparable with respect to emotional?
Both are looking backwards. Hindsight means you are analyzing or studying your past using information that you have today. And when you do that, it triggers a response emotionally, which is called regret. Regret is basically you thinking that in the past I should have done something that I did not do. So hindsight will trigger regret. So hindsight is happening in your mind, and then regret will happen in your emotions. Kumar, representativeness bias means our habit of assigning some characteristics to securities because they are part of some like category or basket. For example, if I ask all of you a standard question, that a lot of these new age startups, digital companies, do they have good work culture or do they have very demanding work culture? What would your assessment be? Like new age companies like Swiggy, Zomato, or even like edtech companies that have now gone bankrupt, like Byju's and a few other companies. So chances are, with one or two instances of some bad work culture being reported, chances are we will apply that characteristic to all the entities. It may not exist for all of them. It may also not exist at all levels in all of them. But generally, we assign some characteristics because we believe all of these entities, even though they may be from different sectors, they are still like these new age companies. From the startup culture, all of these have emerged. So sometimes we have a habit of assigning characteristics because we believe a security is part of a larger group. All right. Last topic that we have for revision of portfolio management is risk management. Risk management is a three-step process. First is to identify risk tolerance. whether we are doing risk management for an organization or for an investor, the first thing is to figure out how much ability the firm or the investor has to absorb the risk. What all processes they are using internally to manage the risk, to govern the risk, what all risk budgeting actions they are taking. So all of that is first step. This is basically deciding how much risk is appropriate for any client or for any investor. Second step is to focus on sources of risk and how you are going to measure the risk. Because the first step is telling me how much capability the client has to bear the risk. But now I want to see what are the actual areas from risk from which the client is exposed to risk. So I'm comparing how much risk client can accept versus how much client is facing. So what I'm capable of bearing versus what I'm actually exposed to, that is step one and step two. Step one is my capacity to bear risk, and step two is my actual exposure to risk. The combined effect of both of these will tell me what steps I need to take to modify the risk exposure. Because sometimes the risk exposure may be too high, so I may need insurance or something like that. Sometimes the risk exposure may be too less, so I'm simply okay to bear the burden. That whenever loss will happen, I will bear it. Now, apart from these steps, the rest of the chapter has nothing new for us to study. When we talk about sources of risk, two categories, financial and non-financial. For exam, I would suggest that you remember only the financial risk category, because everything else you can classify as non-financial. So financial has three components: credit risk, chance that the other party may default; liquidity risk, not being able to convert the security into cash quickly, or if I do it quickly, I may lose a lot of value; and then the fluctuation of market price risk. Apart from this, every other type of risk, political risk, technological risk, regulatory, legal, accounting, everything else is a non-financial risk. And then to measure all of these, throughout our syllabus, we cover a bunch of techniques. In quants, we have studied standard deviation. Then for equity, we study beta. For fixed income, we study duration and convexity. For derivatives, we study option Greeks, delta, gamma, vega, theta. Just terms are mentioned in level 1, no further detail. Detailed discussion of option Greeks is there in level 2. And then we have some other approaches also, like value at risk or conditional value at risk. Value at risk is the minimum loss I will suffer certain number of times. You have calculation in level 2. It uses hypothesis approach. So don't worry about level 1. You just need to know the meaning of VAR. So VAR tells me minimum loss and conditional VAR tells me expected loss. Why do we need both? Because if I tell you the minimum loss you will suffer 5% of times is 10,000. It is good to measure risk, but it is not helpful for me to manage the risk. So if I want to buy insurance to cover this exposure, now I don't know what should be the value of my insurance. Do I take insurance with a claim of 20,000, 200,000, 2 million, or 20 million? Because the statement is I will suffer a minimum loss of 10,000. So anything beyond 10,000 is possible. So VAR is good to measure the risk, but it is not very helpful to manage the risk. That problem gets fixed with conditional VAR because that is a expected value, an average. So average gives me a much better approach to actually measure the risk. Then once I know what tolerance level I have and what I am exposed to, now I will compare the two and decide what actions I need to take. So sometimes we use self-insurance. Self-insurance simply means I will absorb whatever risk I am exposed to. Then we have risk reduction. So maybe I take some steps to reduce the risk, like fire extinguishers are placed in warehouses that in case fire breaks out, we are able to contain the loss early. Then sometimes we have risk avoidance. If it's not necessary, then maybe avoid the activity or investment which is going to bring a lot of risk. Then risk transfer, which is insurance contracts. So I pay a premium and I completely transfer my risk over to another party. And then finally, we have risk shifting. This is using derivative contracts to transfer the risk to the another party. What's the difference between a derivative and an insurance? In insurance, I pay a premium, someone else bears the risk. But in case of derivatives, I am transferring my risk to some other party, but in return, I am accepting a small amount of counterparty risk. So I'm giving a large risk away, but I'm also accepting a small risk. In insurance, that is not a concern. So insurance is just pay a premium and transfer your risk, and that's it. But in derivatives, I give my risk to the other party. In return, I'm expecting a small risk known as counterparty risk that the other party may not honor the contract. So this is your entire discussion for topic risk management. Any doubts or queries you guys have, let me know. Otherwise, that completes our entire revision of portfolio management. Once again, I would advise all the students approach this as the last topic. Whenever in your first revision, second revision, whenever you do it, this should be your last topic, because only then it will feel like a smaller topic. Otherwise, it will end up feeling like a very large discussion.